Welcome to Alpha Recap, your quick, no-nonsense wrap of today's market action. I'm Joe, and joining me is Jonathan, market analyst extraordinaire. As always, if you have questions, you can reach us at stockalpha.ai. Markets closed mixed today, so let's jump into what moved stocks and why investors were talking.
Great to be here. Plenty to unpack, from a big software sell-off to a blockbuster takeover and a reassuring payments print. It was one of those sessions with two very different narratives tugging at markets.
Let's start with the sour note, software, service. Now plunged about 9.6% after earnings, which surprised a lot of people because they actually guided subscription revenue above consensus. Why did the stock get clubbed like that?
Yeah, that was striking. The market punished perceived execution risk. Even with subscription revenue guidance that beat estimates, investors focused on cadence, margins, and whether management can monetize new AI features fast enough. In plain English, if customers don't pay more for AI upgrades, margins get squeezed and growth expectations have to be reset. That fear was enough to send the stock down.
So it wasn't just numbers, but nerves about execution, the how, not the what. Salesforce followed, finishing down about 5.6%. And then SAP chimed in with a cautious cloud outlook. Why did comments from SAP matter so much?
SAP is a bellwether for enterprise cloud migration. When a big enterprise platform signals slower cloud momentum, investors worry enterprise digital transformation could be slowing broadly. That feeds the same narrative. If the larger migration agenda stalls, incremental software spend, and therefore revenue for many vendors, could decelerate. So SAP's tone amplified the sell-off in legacy software names.
Right. Now for the sweeter side of the tape, Adobe reportedly paid about a 78% premium to buy Semrush. That was a one-off bonanza for Semrush shareholders. Jonathan, explain why that premium matters.
A 78% premium is huge because it signals scarcity value in premium marketing data and tooling. Semrush brings search engine marketing data, SEO analytics, and content optimization, things that plug neatly into Adobe's Experience Cloud. Strategically, it's about accelerating AI-enabled marketing features by combining first-party data with Adobe's creative and analytics stacks. For small-cap software, it's a reminder buyers will overpay for differentiated data and integrations.
That sounds like a double-edged sword. On one hand, great exit for Semrush holders. On the other, buyers might be stretching and could disappoint their own shareholders later if integration goes poorly.
Exactly. Optimists say it validates the thesis that data plus integration is valuable and could lift multiples for similar assets. Skeptics point out paying high premiums compresses future returns and raises execution risk on the buy side. It's going to spark more M&A activity in MarTech, but not every deal will be a home run.
Moving on, payments. Mastercard reported a fourth quarter beat, and that seemed to steady things. What did we learn there?
Mastercard's beat was a pragmatic macro read. Consumer and business spending held up. Transaction volumes and cross-border flows were healthy, which points to resilient nominal GDP in the near term. For investors, that reduces immediate recession risk and supports cyclical names tied to discretionary spending. Payment networks still have structural take rate advantages, so a strong quarter there matters.
So while software was fretting about AI competition, payments kept the macro engine humming. Now there was also an interesting behavioral angle today. Google Trends spiked for certain names. Tell us the numbers and why traders pay attention.
Search interest jumped sharply. About 100,000 searches for the phrase meta stock, up roughly 600%, and about 50,000 searches for Microsoft stock, up around 500%. These attention spikes don't change fundamentals by themselves, but they often precede higher flows, volatility, and short-term momentum. Traders use them as a behavioral overlay to spot where retail interest and option activity might pop.
So if I'm a momentum trader and I see a 600% jump in searches for a name, I tighten my stops or maybe chase some short-term flow. But you'd caution not to confuse that with long-term value, right?
Exactly. Treat attention metrics as an early warning or opportunity flag for short-term trades, not as a valuation input for long-term decisions without corroborating fundamentals.
You mentioned corporate filings earlier. There were several 8Ks from industrials and chemicals, Dow, Brunswick, that got flagged. Why do investors need to read those closely?
Case often contain the granular details that move cash flows, restructuring charges, asset disposals, executive changes. Headlines might say company filed an 8K, but the exhibits can tell you whether there's a material one-time charge or a strategic pivot. Event-driven traders live on these, and long-term investors should at least scan them to avoid surprises.
Gotcha. For the record, there was also a small bank data point. Connect One reported GAAP earnings per share of 75 cents on revenue of about $110.3 million. Not headline grabbing, but useful, right?
It's a tidy data point. For value and income investors, those steady, boring numbers matter. They hint at credit environment stability and earnings quality for regional lenders, but you always want to drill into trends and balance sheet details before making allocation calls.
Let's talk disagreement among analysts. Where did opinions diverge most sharply today?
Main divergence was on software outlook. Some analysts viewed ServiceNow's drop as a buying opportunity, solid subscription revenue, recurring cash flows, while others think it's the start of a broader re-rating because AI-first entrants could take share with leaner cost structures. The debate is whether incumbents can monetize AI fast enough to protect margins. Second divergence: how to read Adobe's deal. Is it a value-creating bolt-on or a costly premium that sets a risky precedent? Both sides have valid points.
Practically speaking, what should different types of investors be doing after today's tape?
Short answer: be selective. For long-term growth investors, favor companies with clear AI monetization paths, strong data moats, and disciplined capital allocation. For value and income investors, monitor 8Ks and look at financials of stable banks and industrials for defensiveness. Event-driven folks should watch M&A arbitrage opportunities. The Adobe deal shows meaningful upside exists, and momentum traders should use attention spikes tactically, but beware of reversals.
Any portfolio moves you consider right now?
A few tactical ideas: trim exposure to legacy software names that lack a clear AI plan, redeploy into high-quality payments or software with differentiated data assets likely to attract buyers. Keep liquidity on hand to act on consolidation-driven opportunities, and use attention metrics to manage trade risk rather than to reshape long-term allocations.
Before we wrap, let's put a neat bow on this. Give us 3 crisp takeaways listeners can act on.
First, software faces renewed execution scrutiny. Don't assume incumbency is a free pass. Prioritize companies with clear AI monetization and data moats. Second, M&A is a real source of upside. The 78% acquisition premium for Semrush proves strategic buyers will pay for differentiated assets. Third, payments continue to act as a macro anchor. Mastercard's fourth quarter beat showed transaction volumes remain resilient, and that supports broader economic activity.
Perfect. Quick housekeeping. If you want to dig into any of the filings or numbers we mentioned, head to stockalpha.ai. And if you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll keep tracking the AI versus incumbent story and any M&A that reshuffles the deck. See you next time.
Cheers, Jonathan. That's Alpha Recap for today. Markets closed mixed, stories split between M&A windfalls and software angst, and plenty to keep an eye on. Thanks for joining us, and we'll catch you tomorrow.